would say the fastest, most direct risk management best practice that we could adopt would be to require renters insurance from all tenants and consider the efficacy and cost benefit of force placing that coverage, not necessarily a renter's insurance product, but a tenant legal liability product. I believe it's a good purpose of passing the small to mid-sized severity, very high frequency, tenant negligence for the loss scenario.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Calvin Roberts. Calvin is a nationally licensed commercial insurance broker and principal of Falcon Insurance Agency of Michigan, a boutique insurance brokerage specializing in multifamily commercial real estate. Calvin has been active in the field since he was 19 years old and brings a wealth of knowledge, expertise, and determination to the table, serving real estate investors throughout the United States. Calvin, welcome to the show.
Thank you very much for having me. Excited to chat with you today.
Yeah, and it's great to have you on. Insurance, I know people may not necessarily consider it the most exciting topic in the world, but especially in multifamily, it is a very important topic. So I gave everyone a very high level overview of your background. But on the show, we really like to dig into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Excellent. Thank you. I began in the field right around my 19th birthday. I started off as a lowly all-state insurance agent and very quickly worked my way up to agency sales manager. I was responsible for 10 staff, 2 offices, and approximately a $6 million book of business. And that was a fantastic experience. I got to cut my teeth at a very young age, both in the production and sales side of things, but also on the sales management, people management side of things just as much. But the pain point I very quickly developed was it's like having your hands tied behind your back, only having access to one insurance company. I saw the game that independent brokers were playing and knew that really was where the longevity seemed to be within the industry. So I, approximately 2 years into my career, made the jump to an independent agency, a small mom and pop indie firm based in Ann Arbor, Michigan, and got to cut my teeth in the exciting world of independent insurance brokering. And as an indie, we don't work for any one company. I joke that I am a gunslinger, a mercenary for hire on my client's behalf. You tell me what you want, I'll go and make it happen. I stayed in that role for, again, another 2 years, and it was a fantastic experience. I really received great mentorship from the principal I was working under. But the pain point there was I saw the accounts I was able to win, bring onto books. I didn't own any of those client relationships, nor did I get paid on the renewal. And that's where the real cash flow scalability factor comes in with insurance. It's not that you're going to get rich writing any one policy 99% of the time. It's that they scale behind the scenes and renew each year. That's where it becomes extremely lucrative. So April 2020, I figured there's no better time to bite the bullet, restart from zero than, the shutdown time. That was right as the early COVID shutdowns were taking hold. So I restarted from zero. I couldn't contact any of my old clients, had to essentially hit the pavement and try to drum up business the best of my ability during that time, which with COVID impacting things the way it was during early 2020, it's not like there were multifamily meetups, trade shows, industry events, all of the ways I historically had drummed up business in a more conventional sense. So I became quickly very acquainted with Facebook and LinkedIn real estate investor circles. I'm active in just about every real estate group on Facebook, which I think, and just did things the old fashioned way, but while leveraging technology and the fact that everyone very quickly became comfortable with intro Zoom calls and otherwise not meeting face to face. So during that 2-year period, I worked 1099 for a small startup retail insurance firm out of Michigan and began to build my book of business. And the enticing part about that opportunity is that I owned my client relationships. If and when I left for bigger and better things at some point in the future, those clients came with me. So I was working towards something that was mine, and it was extremely motivating to work 90 plus hours every week. It felt rewarding. So January of 2022, I split off from that agency and formed what is now Falcon. I moved over all of my clients. I book rolled just over $1 million in premium at that time. And that gave me enough of a nest egg, so to speak, where I could be attractive to insurance companies that I was hoping to court, otherwise take a chance on a determined young man like myself. I had enough premium blight on the books to where they're making money on day one, even if it's not a colossal amount of money yet. So 2022, I finally had sufficient working capital to be able to do some of the more exotic marketing plays I thought up over the last 6, 7 years. And it seems to have worked extraordinarily well. We've gotten to scale very quickly. Today, I have a team with 5 team members, 4 insurance brokers. We very much are growing past that small mom and pop indie agency scale extremely quickly. And I owe much of that early success to going after not the biggest, not the smallest multifamily investors. Our sweet spot is somewhere between 50 doors and maybe 2,500 doors. We have accounts bigger and smaller than that threshold, but seems to be a underserved niche where you're way too big for an independent insurance brokerage who doesn't specialize in multifamily or otherwise doesn't have significant experience going after this segment. But you're also comparatively a lot smaller than some of the very big customers on the books at a Gallagher or a Marsh or any of the top 100 insurance brokerages. So where we fit into the puzzle is we give our clients the attention and attention to detail that they expect and deserve. We have access to just about every insurance company who competes and wins on multifamily insurance. So it's not a question of the bigger players have broader market access. There's fairly limited options for multifamily, and we have access to just about all of them. So we're able to go toe to toe with the big boys and fight off the accounts that maybe they're not doing a bad job on, but just not otherwise giving any special attention to. It seems to be working extraordinarily well.
And that's awesome. And there's so much that I want to dig into there. Even before we get into the nuts and bolts of insurance, the thing that kind of surprises me and may surprise some of the listeners is just the entrepreneurial nature of your journey and how there's just so many of these aspects of being an entrepreneur that went into how you got to where you are today, starting from one thing, building up, then having to shut down shop, but getting right back up and starting anew. And then I see parallels when you talk about not owning, that book of customers. It's very similar to how a lot of influencers and others talk about their presence on social media, right? Hey, they have this many followers on Instagram, Facebook, LinkedIn, and that's really all for naught if like they decide to change their algorithm or they shut down. And so you never really own those contacts until you bring them onto your list. And that just seems very similar to me to what you're talking about with bringing the customers into your fold as an independent business owner versus working for one of the corporate giants to bring them customers, not necessarily bring you customers.
Exactly. It's just a different relationship that you have with the business you're in when you own what you're working on, what you're working for. So it's been extremely motivating myself to own my client relationships. It's encouraged and rewarded me for putting in the long hours and being available essentially 24/7 for our clients because it's my baby I'm working to build. So just has that more emotional connection to the work.
Yeah. And it goes back to that adage that you can either work to make someone else rich or you can work to make yourself rich. And you're much more motivated to do the latter, right? No, it's a great story. And the other thing that I was going to hit on is I imagine with all these ups and downs, you built a certain amount of resiliency as well. You talked about coming in, especially trying to build any kind of business during the beginning or middle of the pandemic. That's hard enough, but it seems like it's helped you in some sense, even if it's in retrospect, to make it through that time. Would you say that's true?
Oh, absolutely. If nothing else, 2020 and 2021 definitely put some hair on my chest. It was pretty scary at times, but I wouldn't trade the experience for anything in the world. I feel it's given me much greater tenacity to go and get what I want to get than if it had just fallen into my lap without that element of perseverance and grit, so to speak.
Yeah. And the other aspect that you talked about was finding your niche. And can you talk a little bit more about what you view Falcon's niche to be exactly and how you cater to those specific clients?
So absolutely. So our bread and butter is the multifamily apartment investor. We take on really anyone who buys structures with four walls, is what I commonly joke. Any kind of real estate insurance, we're pretty dangerous, but our true core focus and specialty would be the multifamily apartment investor. It's what we know best and what we have the most experience working on. I'll give an example of how we do things extraordinarily different. I'm not just the guy who writes you a policy. You might talk to me if you get a certificate request from your lender, and then you don't hear from me again until the next renewal. I like to be very actively involved in my clients' operations. And a big part of the holistic risk management strategy that we bring to the table is taking things that extra step. I'll give a good case example. I'm working on it's 195 units, nice Class B, late 1960s frame garden style apartment complex in Southeast Michigan. And overall, this apartment complex, save for the largest building, which is 49,000 square feet, non sprinklered, everything except that building fits in pretty nicely to an auto owner's, to a Westfield, to a Travelers, or a State Auto. It's not extraordinarily complicated to fit every other building. And with one of the more conventional admitted markets, they're going to have the best pricing whenever they'll agree to underwrite the deal. What makes this deal challenging is that the largest building is 49,000 square feet, non sprinkler, built in the 60s. Insurance companies are limited in the amount of capacity that they have for non sprinklered buildings. And it's not necessarily Travelers or Liberty Mutual or whoever else saying, oh, we don't want that. That's too much exposure. They are they have their hands tied behind their back by the reinsurance treaties that exist. Reinsurance says, sure, you can write greater than 5 million for building limits for non-sprinkler if you'd like, but we are not going to provide reinsurance or that type of arrangement. It's just not something that fits into our appetite. And the conventional and, in my opinion, kind of lazy answer or advice that most of my peers or colleagues might give the building owner is, oh, you should install sprinklers and then just leave it at that. I've heard that one quite a few times and it's true. You're not really saying anything they don't already know. How much value is that suggestion really adding? So I know that this property, the debt, it's on Old National paper. They're a mid-size, kind of super regional bank with a significant presence in the Michigan multifamily segment. And I work with out of their Ann Arbor office, one of the commercial lenders who focuses and handles most of their multifamily lending operations. So we were on a call for an unrelated client. They had an upcoming renewal a couple weeks ago. I'm like, hey, Troy, what do you think about a long-term amortization construction loan that would enable this property owner to go in and just quick and dirty over the drywall, even install sprinklers in this building? Is that something that fits into your lending appetite? Could you possibly consider something like that? I'm not talking about XYZ apartment complex, of course. I know you can't discuss your client's personal banking details with me. Let's say it's a hypothetical building that looks identical to this other apartment complex that you guys provided that on. And he gave a quick rundown that it could quite possibly fit into their appetite, and this might be something they can make work. We'd have to discuss it with the client, of course, but the lender could possibly play ball if all other pieces seemed agreeable. So I then reached out to one of my other clients who is a construction project management consultant, had them put together some quick napkin math for what a retrofit project like that might entail. He's estimating around $8 a square foot. I think that's probably reasonably accurate. So all in for this building, you're looking at maybe, I don't know, 400,000 total construction costs to retrofit, install sprinklers. I believe that the insurance savings on day one would be somewhere around 50,000. I'm working on putting together a subject to quote just for comparison and kind of a high level overview purpose. The client can see what their premium would be if we were able to make good on this possible project. So let's say you're saving 50,000 year one, and let's underwrite that maybe insurance we expect to escalate maybe 8 to 10% over the next 5 years. I think that's probably a reasonably accurate forecast for insurance cost escalation. With a $400,000 cost basis, you're looking at covering your cost of this project within, I don't know, maybe 6, 7 years, something like that. Beyond that point, you've covered your cost of pure profit. What else will that do for your net operating income? How will that impact future valuations? Because one of your largest expenses has been reduced by 30 to 45%. That's going to positively impact the future valuation of the property. We'll be presenting this game plan to the client over the weekend. I think it's one of the more clever and more applicable scenarios of holistic risk management that we bring to the table, because the less motivated advice from some of my peers and colleagues would be, oh, install a sprinkler. We take it not just a step further. We put together all the pieces, at least on a high level overview, necessary to complete such a project together as a turnkey solution to managing risk. I think that's a much more respectable outcome, if nothing else.
Yeah. And that's a great example of how you can bring value to the client because you're not just giving a solution, you're basically building it out for them, but and not just doing it by yourself, right? Because especially in this game, it's rarely one person or one entity. There's a host of players involved with these large buildings. So you're talking about bringing all those relevant players to bear on finding the solution to that owner's problem, which I think is really impressive. And, as you were talking about it, I was, of course, churning through my brain. Okay, so how many years would it take to recoup the cost of putting this in? Because that's what it all comes down to is dollars and cents, right? I don't think anyone is opposed to making a building safer. We all want our tenants to be safe. But at the end of the day, we can't go bankrupt doing it because there's no benefit to the tenants if we lose the property because we over leveraged or put too much money into the property. And so I think that's a really great example. One question I would ask about that though is just for the benefit of the listeners, what is the legal requirement when it comes to sprinkler systems? I know it's just some buildings before a certain year may not have them based on the laws that were passed to where they had to have them. Do you know offhand? And then also like number of units, I think is the threshold, right? It's a specific number of units.
It seems to vary and be inconsistent from municipality to municipality. I
Okay.
see sprinkler requirements coming into the picture anywhere between the late 80s and the early 2010s, kind of depending on where your property is. And there's also the qualifier of size. Some municipalities seem to go off of gross building square footage.
Mm.
Others seem to go off of a total unit count. So it seems to be almost determined by the local elected officials who are in charge of determining such criteria in your local area over the last 30 years. That's seemingly all over the place.
Yeah, yeah, as it often is. I think that's a good point though. And you talked about how there's that break even, just let's say at 6 years. Now, assuming that this property is a 7 year hold, right? We're looking at it as a potential takeover and we factor that in at the beginning, then I think it makes a lot of sense. Now, if you're at the end of that deal, maybe it doesn't make sense for you to do something that's going to take that long to recoup, of course, but you just need to look at that because, like you said, if it's already done, then that's something that the new buyer coming after you won't have to do. And so it'll inherently increase the value of the property based on the fact that it's up to code. You won't have to do this huge investment. And then the insurance savings on the backside.
Absolutely. It seems to be a really a silver bullet because they're for this property doesn't seem to be based on the current characteristics of the property, a better insurance solution that exists. I threw spaghetti at the wall, went back to the kitchen, filled my plate again, threw that at the wall. We had that process probably 3 or 4 times. We're out to, I don't know, 80 insurance companies. I've blasted this out to just about every market who might have a 1% chance of winning this. I made no assumptions on who the ideal placement could be. And I don't necessarily disagree with the program it's written with right now. It's on a layered program called Cross Cover, where it's 5 insurance companies, each sharing quota, a portion of the loss they each are responsible for. It's not terrible for what it is, but at the same time, if we were able to solve permanently the largest building concern via the installation and retrofitting of sprinklers, we're then able to get out of the excess and surplus world of insurance and get into the admitted market. That's where Travelers or Greater New York or State Auto or just about any of the other conventional players for multifamily, it then falls within their appetite. They can write those larger buildings, but it needs to be sprinklered. That's the key qualifier here. And it would immediately reduce the insurance expense somewhere between 40,000 and probably 65 on the high end.
Yeah, that's amazing. So let's zoom out a little bit. And we talked about the very tactical level stuff and how that can make such a huge impact on the bottom line. But just give me an idea of where the property insurance market is at right now nationally. I live in Florida, where property insurance is a huge issue. It's constantly being talked about within the local government. Insurers fleeing because of the costs associated with natural disasters and the over litigious nature of Florida. And I'm sure some of those similarities are shared by California and other states that are also having insurance struggles. But just give me a brief overview of what you're seeing in the general marketplace.
So across the board, it's not good. I'm seeing players pulling out just about it every day. Nationwide, for example, they've been one of my kind of go-to core multifamily markets for many years. They are pausing new multifamily, the habitational segment, as of June 30th. So end of month, we're pumping the brakes. Will they turn it back on in the future? We'll see. But you're seeing some of the most stable players who don't typically decline habitational and otherwise pull out of that segment begin to lose their appetite. It's one thing to lose money on the insurance segment for 1 year for 2 years, 3 years. But when it becomes just about every year over the last six, insurance companies then begin to reassess what they're doing. So it's all bad. I think we'll continue in a bad direction for at least another year or two. And then hopefully, fingers crossed, the market will begin to soften. The rate will get to the point where the combined loss ratio across the industry improves enough to where outside capital begins to come back in to multifamily insurance. Because in 2023, you're seeing stable players saying, I've had enough of this, I'm out, and stopping all new habitational just about every week.
Wow. Yeah. And I think that's surprising, at least for me and maybe for others to hear, because we so often view insurance as this thing that we just pay, and never see anything for. So the idea that any insurance company would be losing money is just really hard to fathom for most people. But I think it really comes down to not a whole lot of like little things that are hitting at their bottom line. It's these huge catastrophes, right? Say you have a tornado or a hurricane that causes billions of dollars in damage. That's a huge hit. They may not happen all the time, but again, it hurts when it does when it does happen. So even though they're collecting all this money from people who never expect to get anything out of it, it's those, it's probably focused on specific areas, specific property types, I would imagine, that are the highest level of risk. And I guess my question to you would be, do you feel like those areas or building types that are associated with the highest level of risk, are their premiums sufficient to commensurate to their level of risk, therefore balancing out instead of just raising the prices for everyone else?
I would argue probably not for just about any multifamily built prior to, I don't know, 1976. Roughly once the aluminum era ended, buildings have generally experienced a lower incidence rate of those electrical fire losses. Start overall built by more modern standards seem to be less susceptible to those catastrophic loss scenarios. And you're starting to see insurance companies hardening their approach to just about everything built prior to 1976, especially prior to World War II, and double especially prior to 1900. We're trending in a direction where there are very few admitted players left for just about any 19th century real estate. I have one renewal where it's two 30,000 square foot buildings adjacent to each other, built in 1890, and they're mixed use. So the ground floor is occupied by mercantile, like a light restaurant or a retail store. The apartments above that, they're not sprinklered. I was able to get this through Nationwide in 2021. I pulled it out of excess and surplus. They stayed on the account. It just renewed on June 7th. And I was actually on a boat fishing with the client when I got the email from my underwriter showing the initial renewal. And I just started chuckling. I'm like, oh, you're going to love this, which I worked my magic. I was able to keep the year over year total insurance cost to around 18%, which for an older building like that was no small feat. The initial renewal offer was a 115% increase. Went from 19.5 to 41 and some change before I worked my magic. I was able to keep it to about 23.5, which not great, but it's a lot better than what it
Wow.
would have been below benchmark.
Yeah. And I guess no one should be surprised that a 100-year-old building would have higher insurance costs than a recent one. But so going back to property owners, what are some of the quickest changes that property owners like me can make to our multifamily assets to lower our insurance costs? Are there any low hanging fruit that we can implement as soon as acquiring a property that'll immediately lower our insurance costs?
I would say the fastest, most direct risk management best practice that we could adopt would be to require renters insurance from all tenants and consider the efficacy and cost benefit of force placing that coverage, not necessarily a renter's insurance product, but a tenant legal liability product. You probably see something pretty similar offered by your property management software. A lot of them seem to come with something like this baked into the product anymore. I believe it's a good idea for the purpose of passing the small to mid-sized severity, very high frequency tenant negligence for the loss scenario. You have a tenant who, I don't know, maybe they just worked a 10, 11-hour shift and they get back to their apartment. They crack open a couple Bud Lights or whatever beer and they throw a frozen pizza in the oven, fall asleep on the couch, and wake up and fire detector is going off and the kitchen's on fire. And they run out to the hallway, they grab the, I don't know, fire extinguisher and put the fire out, but not before it can do 60, 75, $100,000 worth of damage to your property. Gets pretty expensive fairly quickly. Without the tenant liability risk transfer mechanism in place, our question becomes, do we file a claim? Is it worthwhile? Is paying 60 grand out of pocket the least painful option for us over the long haul? We don't want to spook the insurance company and get not renewed, end up in a worse scenario and just pay for it over several years. Or do we file the claim and take our chances with that not great non-renewal scenario? With a tenant liability master program, that isn't a thought that we really ever have to have, especially on the small to mid-size, high frequency negligence loss, because that scenario is passed off to a secondary insurance company where that doesn't affect our loss ratio on the property policy, the no harm, no foul for the primary policy we have in place. And you additionally pass that additional cost off to the tenant in the form of a line item, additional item on their monthly rent bill. And you can even make this into a profit center for your management operation. Maybe your cost is $10 per door per month, but you charge your tenants 15, 16, 18, 20, whatever you think they will pay, the amount that they'll pay. That spread is yours to keep. It's an additional new revenue center that previously didn't exist. We set a program like this up for one of our property management companies who they manage just over 3,000 doors in Michigan and Ohio. And this process, which takes them, an additional 5 hours of labor each month, we take on 95% of the clerical duties, really just need to chat with them to confirm a few things each week. But it's generated approximately $75,000 additional cash flow for that organization with a total time investment of maybe 50, 60 hours per year. That's pretty good.
Yeah. So let me clarify. Is that in addition to renters insurance? Because we require it for most tenants on most buildings. Is that different or is that the same? It supplements it is renters insurance.
It's very similar to renter's insurance. It's not the renter's insurance, the HO4 policy form. So I can't call it renter's insurance. The key difference is that the tenant legal liability master program doesn't provide the loss abuse coverage that would put the tenant in a hotel or a temporary apartment if their unit becomes damaged due to a property loss. But really what makes this attractive is the compliance element. You can require all day long that your tenant provides you with a State Farm renter's policy or whichever company they're choosing. But then they get the keys to the apartment, they cancel it a month later, we're back at square one, and nobody really wants to evict the tenant just for that. Sure, it might be prohibited by the lease agreement, but it's not worth picking a fight over 99.9% of the time. So your options then are tolerate them being incompliant with the renter's insurance requirement or evict them. Neither is really a great outcome. This program allows you to force place that coverage, pass the additional costs off to the tenant. You can even build in that X dollars per door per month profit margin for yourself to make this directly financially advantageous to the operation.
Okay. And so, like in the example that you provided, would they have both? Did that owner or property manager require renter's insurance as well as participating in your program? I'm just thinking of the fees from the tenant perspective. If they would view that and be like, why am I being charged twice for what is essentially, you know, renter's insurance?
So I typically see it as a either or scenario.
Okay.
So the way we have traditionally set this up is if the tenant emails, we have a special email for this program where they can deliver proof of compliant renter's insurance to Falcon. Once we mark it as compliant, we unenroll them from the program. They're not charged double, essentially. But there is the option, depending on your management approach and preference, of requiring this program, even if they have their own independent renter's insurance. Most multifamily operators don't take that second approach, but my understanding is that from a legal perspective, because this is not renter's insurance, it's a different but similar product. It based on the feedback I've gotten from some of the organizations we partner with to provide this product, you do have generally the legal right to require this in addition to renter's insurance if you prefer to go that direction.
Sure. And one last question on this potential money saving on insurance. Does installing something like a security system, an access gate, does stuff like that actually reduce your insurance costs? And in your experience, have you seen it being worth the money, the juice being worth the squeeze on those?
I would argue for security systems, most likely not. You do get a certain percent credit that is different for each insurance company. But for something like that on the security side, it's probably between 1% and 2% of total premium. So you probably won't even cover your own cost of the installation of these safety protective devices. The monitored fire system, that can be worthwhile. That's usually between 3 and 5% of the premium. And that could cover its cost of installation and ongoing use of a monitored fire system. ADT, or I saw Xfinity as their own competing product. It can sometimes make sense from a direct cost savings perspective, but it's really the sprinkler retrofit scenario I touched on with that other client example earlier in the discussion. That's going to have the highest percent credit on the property policy, generally between 10 and 15%. Sometimes it can make sense in limited scenarios like that. If on that other client example, if we needed to install sprinklers in every building to find significant insurance savings, the numbers would probably be less in their favor. Here, it's only a portion of the apartment complex that needs to be retrofitted to get us that significant degree of insurance savings, because it's not just the credit from having sprinklers. It's that we are, because this problem building is now sprinkler, able to get it underwritten by a more attractively priced across the board conventional player, Travelers, State Auto, any of your kind of go-to national players for multifamily apartments. So it's not just a direct discount necessarily. It's that we're able to get you in with a different caliber of insurance company who the base rate, as it's called, the amount of premium they charge for $100 in building coverage is somewhere between 30 and 50% of this kind of uglier option with a layered excess and surplus program.
Yeah, and I think like anything, the answer comes down to it depends. There's a whole host of things I could probably sit here and hit you with. What about moisture sensors that can tell if an apartment is flooded and this and that? But talk about different regions, different costs of labor associated with doing the work that we're talking about. It could be so different from place to place and building to building, and the circumstances, like you talked about, of even the specific building. So we can't dive into all of that, but that was some great insight, and I appreciate that. Now it is time to move on to the turbo round. So I'm going to ask you 3 questions in quick succession that I ask every guest that I have on the show. And I just want you to go ahead and answer them quickly and honestly. The first question is, what is one red flag every investor should look out for?
If you're looking at the seller pro forma and you see an insurance premium that looks too good to be true, it probably is. That's something I call out seemingly on 75% of seller reported numbers. And it's not that I think they're fibbing on the insurance premium. I don't think they're doing that. What I usually see is insurance pricing is pretty simple math. It's exposure, the amount of coverage we have for the buildings, times the rate, the dollars in premium we charge for $100 in coverage. So if the seller is reporting an insurance premium that I know is possible to obtain based on exposure times rate, how are they getting it? It's not that they're getting a much better rate necessarily. It's that the exposure is probably a lot lower than it should be on the policy. And the exposure meaning the amount of coverage they have for the buildings. More often than not, I see that a good chunk of my colleagues just leave policies to autopilot, or they set it and forget it, and just let it renew automatically. If you're doing that and you're not running a replacement cost estimate for every building, every policy, every year, I'm sure you can get away with it for a year, maybe 2, maybe 3. But eventually inflation is going to cause the amount of coverage we have on the policy to be insufficient to avoid things such as co-insurance penalty. So if, the seller's property limit is more than enough to cover their cost basis of the acquisition or even what they think the retail value might be presently on a property, but it's maybe 50% of what it would cost to actually rebuild today, and I come in and I quote it with 80% limits, 80% of what it would require to rebuild, my exposure has then increased by, 65%, something like that. So I'm going to, in an apples to apples rate scenario, have a premium 65% higher than what the seller is reporting. So it's one of those things where the insurance premium can almost be gamed to produce the number that you want it to produce. The question is, will the claim get paid without incident? Or are they going to say, gotcha, we have this clause, and for these reasons, we're paying you half of what you believe we should be paying you? Those are the games I prevent. I won't write a policy that will lead to an ugly claim scenario. I'd rather go out on the deal and try to convince the client you're making a mistake for these reasons. But if they insist, because the end premium is the only thing that is important to them, I'll go out. That can be someone else's landmine of their own creation, because that client is going to sue the insurance broker when things don't go the way they believe they should in a claim scenario. And it's just not the right approach to doing business, in my opinion.
Yeah. And when it really comes down to it, if I'm that buyer and I'm solely focused on the lowest cost insurance, I'm probably incurring the risk associated with being underinsured, just like you can incur the costs with being overinsured if you have too much. And so you have to find that balance. The only thing that I would add to that is that as a potential buyer, if you see that red flag and it looks too low, you should be doing your own due diligence to get quotes anyways, and talking to someone like you to get a realistic picture so that you can accurately underwrite that deal. Because as we know, insurance is one of the biggest costs associated with owning and running one of these properties. So if you have that wrong, then all your numbers are going to be wrong. It'll be a cascade effect. All right, on to the next question. What is a myth about this business that you would like to set straight?
Ooh, I would say the key thing on everyone's mind, and I get where my clients are coming from, because it's tough to stomach a 15, 20, 30, 40% renewal increase after we've had similar renewal increases for 2 or 3 years now. But the number one myth I see is that insurance companies are printing money on real estate insurance, I see the combined loss ratio across the industry. And I'll put it this way. I've had aspirations of eventually working toward forming my own insurance company, not just an agency selling products, but providing the paper that the policy is written on. I count my blessings every single day that it's not my capital on the line to settle these real estate losses. Because if you're paying 200 grand a year in premium, how many people like you does it take to cover just one complete loss? And how many non-total losses did the insurance company also sustain? So it's not a business where I'm full of jealous envy and greed of the insurance company. It's a tough business to make any money in. So I would keep that in mind as you get that renewal notice, because as long as the broker is being diligent and can show this with a marketing report. I have one where we went to something like 75, 80 insurance companies for that July 8th renewal, the 195 unit mid-Michigan. I can't make insurance companies underwrite a deal. I can present it to my underwriter in the most attractive way possible. But ultimately, their hands are sometimes tied behind their back by hard guidelines imposed on underwriting, where it's not something they can be flexible on, even if they think it's a good risk. It's something they would want to be flexible on. So ultimately, you need to see that your insurance broker is being diligent with their marketing. And they should be providing you a complete marketing list that shows where each company comes in with their bid, if they bid, why they didn't want to underwrite the deal, etc. You see that ultimately they're doing everything that's in your best interest. Can work toward a good outcome for you.
Yep. So it sounds like that myth really comes back to what we were talking about earlier, that the misconception that I had, that insurance companies are just swimming in money and making money hand over fist with every time they jack up your insurance premiums. All right. What does success look like to you?
Success looks like personal fulfillment, both in your private and business life. So if you're feeling accomplished and you fulfilled the goals that you set out to fulfill, that's success. For some people, it's buying an apartment building. For others, it's buying 10,000 apartments. For someone else, it might be working at General Motors and then retiring at 55 and hanging out with their grandkids on the beach in Florida. Everyone has a different definition for what made it looks like. For myself, I have a lot of very expensive hobbies, everything ranging from aviation. I'd love to get my pilot's license at one day. But also it's that element of being able to provide for me in mind that drives me. I want to make sure that I have the personal financial resources to see family through, to see friends through. I don't want to be Mr. Rich Uncle, just cutting a check and being used by family. But I want money and resources to not be something that those in my world ever have to worry about.
Yeah, absolutely. I can definitely understand that. All right. Hey, Calvin, this has been awesome. I know I've learned a lot, and I could certainly sit here all day and pick your brain about insurance stuff, but I really appreciated the opportunity to talk about this topic because I feel that it's very underrated. And you may disagree, but I know some people don't think it's the sexiest topic associated with multifamily. But as we discussed, it certainly is one of the most important, just based on cost alone and how much of that cost is wrapped up into any property that a multifamily owner has. So please tell all the guests how they can get a hold of you and if you have anything else that you would like to share with them.
Absolutely. I am extremely attentive to email, phone, LinkedIn, Facebook. My email is Calvin, Calvin, at Falcon, INS agency.com. Telephone 734-887-9110. I'm also extremely responsive to Facebook, LinkedIn, Carrier Pigeon, Smoke Signal. if you want to reach me, I will respond quickly.
All right, awesome. Thanks again. We'll definitely have all your information in the show notes. I appreciate you coming on and look forward to continuing to see you do big things on your journey to multifamily millions.
Thank you. I appreciate the opportunity to speak with you.